This is Morning Stock Watch with the weekly market report for the week ending August 14th, 2020. This report includes the broad market sectors, along with Tesla and Netflix. Starting with the S&P 500 ETF, SPY. Weekly closing price of $336.84, up just under 1% since last week's close. This is the weekly chart of SPY. The market has been in recovery mode since the lows of March 23rd. It's taken just 26 weeks to recover the losses from the pandemic. This week our candle closed as a green spinning top with moderately high volume for the size of the candle. In general, the higher the volume for a spinning top or hanging man or any topping pattern, at the top of a bullish trend, as well as being at resistance while being at all-time highs, gives a clue to the trader that the market is preparing for something other than the current trend to occur. This could be in a sharp move up or down, likely to the downside. In order for that to happen, we need to see this lower trend line broken, at least at the daily chart. That'll take a bit of force, but it's getting increasingly easier to happen as price inches up. We also have on the MACD and RSI charts, negative divergence building up since the last time price has been at this level, back in February this year. On the daily chart, we see that price continues to remain in an up channel, making lots of contact with support and resistance over the past 21 weeks. This proves to be a very strong channel, with many traders watching support to give way. Looking at moving averages, we see those are starting to diverge away from each other, which can open up the possibility of larger gap downs, with each moving average being an area of support. Clusters of moving averages create stronger support for price to bounce, and we see we're getting less of those these days, with negative divergence on price and the indicators, which is a bearish signal. Looking at volume, we are seeing less volume as the price continues to rise. It's a sign of weakness in the trend, and it doesn't mean that price has to come down immediately, but it is preparing for something. Looking at the 11 market sector ETFs, simply looking at the weekly candles only in comparison with the S&P. This week we saw the market led by industrials up 5%, followed by financials up 3%, with high volume topping candles on several of the charts to include the Russell 2000, the IWM, QQQ, IWM, healthcare, financials, and industrials are among the charts that have some kind of topping candle with increased volume this week, which shows some weakness in those markets, along with consumer discretionary and consumer staples, both having increased prices with consecutive green candles getting larger while having decreasing volume. That is a sign of weakness as well. Now, let's look a bit closer and see where the S&P can actually be going. As always, there's two sides to every trade, and the idea is to be on the good side of the trade more times than not. What we know so far, we see that from the SPY that the market can easily continue higher or lower from its current position. The market is giving off an impression that it wants to take a breather and maybe revisit some lower prices, like maybe 327 or 323, possibly 305. As we know with the market, this could continue higher without a break, but remember that the higher it goes, the harder it can fall. Right now, our upper price target of 340 remains. Above that is 342.50, 345, etc. As the price is now at all-time highs, there is no areas of previous price resistance to get through. Next we have is Tesla, weekly close of $1,650.71, up over 14% since last week's close, and up 75% since the highs in February, which many people called it a bubble. The weekly chart, things are looking good for higher prices. If not now, it will in the very near future. This week has an extremely bullish candle bought up from the lows near the conversion line of the Ichimouku indicator. This is also somewhere near the 20-period moving average. Last week looked like we were going to get a break to the downside due to the low volume on the two suspicious-looking doji candles right on top of support. But we got a good amount of buying this week, and it's beginning to form a bullish pennant with price targets of over $1,680 or so. On the daily chart, we see the week's action. On Friday, price closed on top of support and opened Monday morning below, eventually retesting supply here at 1375. 1400. Had a gap up open and a wide up candle here, ending the week with two spinning tops, with Friday's candle having moderately high volume. The volume looks to have Tesla possibly at least retesting support of the upper trend line and maybe even the green conversion line. Also, there were talks of a stock split a few weeks ago. Sure enough, it appears that there will be one at the end of the month on the 31st, a 5-to-1 split, and will bring the stock price down to around $350, given today's price. For those who already hold the stock, won't lose any money, but the amount of shares will increase, making up the amount of cash invested. So if you own 1 share of Tesla stock today, you'll own 5 shares at $350 after the split. This can actually make the stock more attractive to those who didn't get in earlier. So Tesla will be one to watch for a while. If the market can at least go sideways a bit before reaching its target, we might actually see 2,000 for Tesla before the split. Downside areas at 1520 trend support, as well as 1330s here at the lower trend line. And last we have is Netflix, weekly close of 482.68, down over 2% since last week's close. Last week we said if for whatever reason price couldn't make it back above 520, we could see price drop back down to the 470 range, attempting to make it back into the channel. This week price made it to as low as 466 and closed the week below some important numbers. 520 and 500 were two we wanted. This week closed as a red hammer with lower volume than the preceding dojis. What does price look like it's doing here? It kind of looks like it's going sideways at the bottom of the downtrend, but underneath the green conversion line, as well as below the lower trend line of this bearish wedge pattern. The wedge is still reaching to about 580. It's possible that price can continue to push up while remaining underneath the wedge, making it up to 580 to have a large correction. Taking the largest part of this wedge and adding it to the tip of this wedge, we can sometimes get a ballpark of the correction. That corrected price is around where price is now, around 480. As we can already see, there is a lot of price action building up here at 480. That would be the new critical number for Netflix. Continued downside for Netflix should be watched for around 450, 415, and 400, with as low as 385. Anything below 450 would be a definite buy for Netflix based on its fundamentals and outlook. If you found this report useful in any way, please be sure to like, share, and subscribe. Thanks for watching, and hope to see you next week for another weekly report.